All right, guys, we'll be starting in about 7 minutes here. I just want to do a quick sound check. If you guys can hear me, please type yes into the chat window. Okay, great. So we'll be starting here in about 5 to 6 minutes, and we'll be talking about trading your first option. I'll be right back. All right, welcome everyone to today's webinar. We're going to be talking about trading your first option today. Before I get started, I just want to do a quick, make sure everyone can hear me. If you could just type in yes into the chat window if you can hear me. Okay, it looks like everyone can hear me. Great. So before I get started today, like I said, today we're going to be talking about placing your first options trade by a raise of hands. If you have already traded your first option, just type in option into the chat window. If you're completely new to this and you've never traded option before, just type in no, just so I can get an idea as far as how many people here. Okay, so pretty much everyone has put no. I have one person here who's traded an option, but pretty much everyone here is brand new to options, which is great. That's exactly what we'll be talking about today, is showing you what you should be looking for, what are some simple strategies you can take using options. So just to talk a little bit about what we'll cover today, if you look at the strategies that you can use options for, what we really want to do is show you guys how you can use options to supplement what you currently do in your portfolios. So we'll cover two basic strategies: calls and puts, which are basically directional strategies, and then we'll also talk about covered calls, which is an income generating strategy. These are the two most popular strategies for beginners when they're starting out. The reason people look at options is for a few different reasons. Number one of the best reasons is really for a lot of traders. They may have bearish views on a specific stock. They can't take a bearish view just using the stock unless they short the stock. And usually there's a lot of intricacies with doing that prevent users from being able to short a stock. So buying puts usually is a good alternative. The other thing is, you can use options to generate yield on the stocks you already own in your portfolio through a strategy called cover calls. So we'll cover that a little bit as well. But then I would really want to talk about a little bit about stock analysis, because it's really important before you trade options to understand how you analyze the underlying stock in order to drive what types of strategies best suited for you. Because you first need to have a view on the underlying stock before you can trade any options. So it's important to understand kind of what type of analysis you do. Then what I'll talk about is understanding the Greeks. For those of you that have traded options or have started to explore options, you might be familiar with a term called the Greeks. I get a lot of questions about what they are, what they mean. So I'll give you a brief overview as to the two Greeks that you need to pay attention to. But more importantly, what we'll actually do is show you how to actually convey them or how to use them using our tool, OptionsPlay. And then we'll cover some of the common mistakes that beginners tend to make when they're starting out with options to hopefully help you avoid some of these mistakes. And then lastly, or most importantly, what we want you to be able to do is walk away today being confident in having the abilities to take what we're teaching you today and know how to implement these strategies for your portfolio using OptionsPlay. This is a tool that's available to you guys free of charge within First Trade, so I highly recommend after you go through our webinar to go take a look at this tool, because it's designed to help make options trading much, much easier, especially if you're a beginner. So let's just talk about some basic strategies. Number one, buying calls or puts. If you've done any research on options trading, you'll be familiar with these two terms, calls and puts. It's a very simple strategy, or at least the most simple of the option strategies. If you're bullish on an underlying stock, a strategy that you can take is you can buy calls. If you're bearish on the underlying stock, you can buy puts. So those are the two main strategies that you would take if you have a directional view on an underlying stock. And you can buy calls or puts independently of each other. You can buy them together. You can do combinations of each other. That's where the more complex options trading gets into play. But today we're just going to cover simply buying calls and buying puts. So for those of you that are looking for these types of directional strategies, meaning you have a view on the underlying stock, you think it's going to go higher or you think it's going to go lower, generally speaking, the question that I get asked the most is what expiration should I choose and what strike prices should I choose? And for those of you that are beginners, and you're trading these strategies, generally speaking, we'd recommend that you stick to relatively short dated options, so usually 1 to 2 months out in terms of expiration. And in terms of picking strike prices, you usually want to pick prices that are somewhere around the current price, or what we call at the money strikes. So strike prices that are near the current price are going to be useful for those of you that are beginners and starting out and you're just buying your first call or buying your first put. You want to trade options that are about 1 to 2 months out, and you want to buy strike prices that are very close to the current price of the stock. We'll go over these examples with some real stocks using OptionsPlay in a few minutes. The second strategy that I want to go over is cover calls. For those of you that currently trade stocks or currently invest in stocks, this is a great strategy for you to take and test the water with options, because it allows you to generate some additional income on your stock positions. The great thing about this strategy is that it doesn't add any additional risk to your portfolio. So no matter what, your risk is limited when you're selling cover calls. The only thing is that it requires at least a minimum of 100 shares of that underlying stock in order for you to sell a cover call. So if you have any stock positions where you only have 40, 50 shares, this might not be the best strategy for you. You have to have at least 100 shares in order to generate some income. And lastly, you do risk losing that stock, so it becomes a taxable event if you have a taxable account. So these are some of the things that you should be taking a look at if you're trying to place a trade. So these are the two strategies that we'll be going over today in detail, buying calls and puts and selling cover calls, and we'll show you how to do that very easily using our tool OptionsPlay in a few minutes. So talking about stock analysis, before you get into options trading, it's important that you understand how to analyze a stock, because it's the most important factor in determining what strategy you take. You must first have a directional view on the underlying stock before you can place an option trade, because if you're bullish on the stock, you'll want to buy calls. If you're bearish on the stock, you'll want to buy puts. So before you can even decide what option you want to trade, you must first decide, am I bullish on the underlying stock or am I bearish? Next thing you must do is you must have an exit plan, right? So if you're bullish on a stock, you should have an exit plan to say, what happens if the stock doesn't go in my favor and starts to move lower? Or conversely, if you're bearish on a specific stock, you should have an exit plan to say, what happens when the stock moves higher? You should have these levels. A lot of times, a lot of traders will use support and resistance levels to determine where they think the stock's going to go to, or you can think of that as a target price, and where they think that a stop loss, if you will, or a place where they would say, hey, I'm wrong, I need to cut my losses and move on. So it's very important to have both a target price, where you think the stock's going to go to, and also at the same time a downside stop loss to say, if the stock goes below this certain level, I'm going to say that my initial analysis was wrong and I'm going to get out of this trade. And lastly, when it comes to trading these options, especially if you're new, like I said, you want to start around the strike prices that are near the money, or around the current price of the stock. However, if you're brand new to this and you're trying to trade some bullish or bearish strategies, it is recommended to use in the money strikes, or strike prices that are below the current price if you're buying calls, or strike prices that are above the current price if you're buying puts. And we'll go over these in actual detail with real examples, so you don't have to memorize this. So when we think about stock analysis, when we talk about, do you think you're bullish or do you think you're bearish, every single one of you will have different preferences as to how you determine bullish or bearish. Some of you are going to be technical traders that use the charts. Other traders may use fundamental analysis. So if you're a technical trader, or if you're using the charts to determine what to buy and sell, you're generally speaking going to be more on the short term when it comes to trading options. You know, anything from short term day trades all the way up to swing trades. If you fall into this category, you typically will want to trade options that are anywhere from 1 to 3 months out. For those of you that are more fundamental based, if you're looking at a company from a fundamental perspective, you're looking at balance sheets and statements to determine whether you think this company is undervalued or overvalued, you generally want to trade longer term options, anywhere from 3 to 12 months out. Because fundamental analysis is usually something that doesn't play out in the short term. If you find that a company is undervalued, it might take you 6, 9, 12 months for that stock to be fully priced in at the value that you think it should be, which is why, generally speaking, if you base your analysis on fundamental analysis, you might want to trade longer term options, anywhere from 3 to 12 months out. So ask yourself before we move on kind of which one you fall under. Are you a technical, trader that use the charts, or are you more of a fundamental based trader? Because that will help drive kind of what expiration dates you'll be trading when it comes to trading options. Understanding the Greeks. If you go about doing any type of research or education on options trading, you'll probably come across the term the Greeks. And there's a bunch of them. There's delta, there's theta, there's vega, there's gamma, and it goes on and on and on. But the crucial two that you need to be aware of, especially when you're new to options trading, is delta and theta. And these are important because it determines how your option will be priced, or how your option will move based on what your expectations are for the underlying stock. And delta and theta, you don't have to memorize these, because we'll show you how you can calculate these very easily on the platform itself. You don't have to know how to calculate any of these. I'm just giving you the formula for example. So delta tells you what the change in the option price is in respect to the change in the stock price. What does that mean? If you buy a call option for $1 and the stock goes up by $1, this tells you how much money that option will go up by. So if you see a stock, or if you see an option with a delta of 50, that means for every dollar the stock goes up, your option will go up by 50 cents. Conversely, if the stock goes down by $1, you'll lose 50 cents. So if you pay a dollar for an option and the stock goes up by $1, you'll receive now $1.50 for that option. And if it goes down by $1, you'll lose 50 cents. So the contract will only be worth 50 cents. So delta tells you how much your option price will change for every dollar that the stock price moves. Okay, this is important because if you buy an option and you think the stock's going to go higher, you want to calculate approximately how much profit can I expect, and that's what delta allows you to do. And we'll show you how you can do that on the platform. The second thing you need to think about is theta, or be aware of, is theta, and that really tells you how the change in option price, or what is the change in the option price with respect to time. So the one thing about options is that it decays with time. So the value of your option will decay as time goes on. So if you're buying an option, as long as you hold on to it, it's going to lose some value every single day. How much does it lose? That's what theta tells you. Okay, so if you're buying an option, time is working against you. If you're selling an option, time is working in your favor. So these are the two things that you need to understand before you place your trade. And again, you don't have to memorize these. You don't have to know how to calculate this. Our platform does all of that for you, but it's really important for you guys to understand that the two most important factors when you're trading options is delta, which is how much does the option change with every dollar that the stock moves, and how much are you losing or gaining in time value every single day that goes by. These are the two things that you probably don't have to worry about when you're trading stocks, but it is something you have to be very cognizant of when you're trading options. So we'll get into that real quick. So lastly, I just want to talk a little bit about what are the common mistakes that people make when they're trading options. Number one, people tend to hold on to trades until expiration. This is not something you generally want to do. And this is really because of this time decay that I was referring to before, because for every day you hold on to that option will lose a little bit of value. So you, generally speaking, don't want to hold an option all the way to expiration. If you think the stock's going to go higher, so you buy a call and the stock does go higher, get out, take your profits. Don't be afraid to take profits. That's one of the most common mistakes people do, is that the stocks goes in their favor and they think, well, I'm going to hold on to it until expiration. And by the time expiration comes along, they've lost another half of the value of that option. Don't do that. Make sure you try to take profits on your trades ahead of time before expiration. Number two, it's very common for a lot of beginners to trade too short of an expiration. What does that mean? So if you're doing some technical analysis, maybe you're looking at a chart and you think the stock's going to go higher, and you think it's going to take about a month to hit that target price that you want. You generally, a lot of people, what we see with beginners is they'll trade a 1 month option because they think the stock's going to go up in the next month. But that's really where we tell you it's really best to go about a 1 month longer than you expect to, because you, generally speaking, want to give yourself some leeway in case that it takes a little longer to get to your target price. You don't want it to kind of hit your target price after the option has expired. So it's definitely important to usually add about a 1 month buffer on top of what your expected time frame is in order to trade options. So if you think a stock's going to move higher in the next 1 month, you should trade a 2 month option. If you're doing a fundamental analysis and you think the stock's going to take 3 months to fully value, try to trade a 4 or 5 month option. Give yourself a little bit more time on the tail end. Don't trade an expiration that's too short. And lastly, the most common mistakes is not having an exit plan. So when the stock hits your target price, that's a reason to exit the trade. Even if you still have plenty of time to go between now and expiration, to have an exit plan. So if the stock hits your target price, get out of the option trade. If the stock goes against you and it's not going in the direction that you think it's going to go in, also have an exit plan. Get out of that trade, cut your losses so that you have enough capital to make your next trade. This is one of the most important things with options trading, is having a tight exit plan, whether it's going in your favor or against you, so that you get out when it hits that target, when it hits that price. Because if you don't, you're likely going to lose all of your investment when you're trading options. So it's very important to have an exit plan when you're trading options compared to when you're trading stocks. So with that, let's just go ahead and start looking at some real world examples to show you how you can use OptionsPlay and start leveraging options for your portfolio. So here I have OptionsPlay up within First Trade, but for those of you, because most of you are new, I want to show you how you can launch this tool. So first of all, when you're on your First Trade platform, when you go to the trading tab, you can click on options. And once you click on options, you'll see a button here on the right that says Options Wizard. Okay, so again, under your trading tab, click on options, and there's a button on the right that says Options Wizard. Click on that and that will bring up OptionsPlay. Okay, this is again designed to help make options as easy as possible for you, regardless of any views that you have on your account. So when you bring up OptionsPlay, you get 3 panels. You have trade ideas and watch lists here on the left. You have your analytics panel here in the middle on the underlying stock. And then you have trading and income here on the right. So we'll cover these 3 panels, what they mean, how you can use them, but most importantly, how you can find your next option trade. So first of all, trade ideas is new scans that we make every single day. So you have new bullish and bearish ideas in your inbox every day. We have a watch list section. This is pre-built watch list for you. So what we have is different sectors, so you can see how all the different sectors are performing. We also give you a list of all the stocks within each sector. So if you're looking for financials, you can very quickly narrow down to which stocks are in the financial sector. And for any stocks that you click on or type in here, it'll automatically generate the rest of the screen. So Like I said before you get into any option trade, you must first have a directional view, or at least some kind of view on the underlying stock, and that's very important. So what we did is we built a few different tools to help with that process, okay? So regardless of whether you're a technical or fundamental trader, what we do is we provide different analytics to give you an idea as far as what is currently going on with this stock. So first of all, you'll notice that here on the upper right, we have a 1 month and 6 month trend. This is designed to give you a very quick snapshot as to what the short-term and long-term trends of the stock is. So if both the 1 month and 6 month trends are bullish, this is certainly a bullish sign for the underlying stock. Next, we have what's called a technical score. This is a relative strength indicator that helps you quantify how strong a stock is compared to the overall market. And this is scored on a score from 1 to 10. 10 are the strongest stocks in the market, 1 are the weakest stocks in the market. And so for any symbol that you type in, you'll instantly get a reading that lets you know whether the 1 month and 6 month trends are bullish and whether this is a strong or a weak stock. So here for Citigroup, both the 1 month and 6 month trends are bullish. So this would certainly be good for a bullish candidate, and it's a very strong stock. So this is great as a potential candidate for bullish stocks. Conversely, if let's say I look at a stock like, let me pick another stock here. What's a stock that everyone knows? Campbell's Soup, right? Soup company. Everyone knows Campbell's Soup. As you can see, 1 month and 6 month trends are bearish. So this is certainly both the short and long-term trends are bearish. And it's telling me the technical score is 2, which is very weak. So this is a weak stock in the general market. So if I'm looking for bearish opportunities, these are the type of stocks that I want to do. And what we do here in our watch list is we allow you to score and see the trends of each stock or sector very quickly without even having to click on it. So here, XLF, the financial sector, as you can see, the 1 month and 6 month trends are bullish. It's got a score of 7, which is certainly a bullish category. I can see that directly from my watch list, even if I don't click on it. XLI is the same thing. It's got a score of 7, and it's got green across the board. That's telling me that it's got bullish trends, and the score is strong. Conversely, if I'm looking at consumer staples here, as you can see, I've got a score of 3, which is very weak, and the 1 month and 6 month trends are bearish. So even if I don't pull up that stock or that sector, just by looking at the watch list, I can very quickly see which stocks are weak. So as you can see, all of these symbols here that have red across the board and they have scores of 1 to 2, I can very quickly know that these are relatively weak stocks and bearish trends. And if I go to the other end, as you can see, I can sort it by score. I can see here, Estee Lauder and Tyson Foods are strong stocks with green, that telling me these are strong stocks with bullish trends. So this is very important to look at before you place any option trade, because this will drive what strategies you use for that underlying stock. So let's take a look at a few examples here. I'm just going to bring up Citigroup. Because this is a trade that we were looking at the other day. So Citigroup, as you can see, the 1 month and 6 month trends are bullish. It's got a technical score of 9. This is a very strong stock. So as you can see here on the bottom, you have 2 buttons. It says I'm bullish or I'm bearish. And that drives the rest of the screen, okay? So you don't have to search for an option trade to start. We'll actually present ideas for you regardless of whether you're bullish or bearish. So if you're bullish on Citigroup, we'll show you that currently what you can do is you can buy 100 shares of Citigroup. So for those of you that trade stocks, you're most familiar with this strategy. And then what we do is we help provide a starting point for if you want to trade options. So instead of buying 100 shares that cost you $7,500, we're going to show you buying a November 75 call. So this is an option that expires in about a month and a half, November 17th. It's got a strike price of $75. As you can see, Citigroup is trading just around $75, a little over $75 right now. And what it does is it presents ideas for you as a starting point. So you don't have to pick an expiration or a strike price. It already does some of that analysis for you. And there's this third strategy here on the right. For those of you that have traded options before or more advanced, you can take a look at these call vertical. This is a more advanced strategy, but we're not going to cover that today. We're going to talk about basics. We're going to compare buying the stock to buying a simple call option. Now, we talked about delta and theta, meaning how much is the option going to move if the stock goes higher. So today, it costs you $7,500 to buy 100 shares of the stock, but it only costs you $245 to buy one call option. The great thing about buying these calls and puts is that the risk that you put on is completely limited to what you've paid for this call option. So the most you can lose, no matter where Citigroup goes, is $245 per contract that you buy. So what we did is we created a P&L simulator, and this is really taking the concept of delta and theta and giving you a tool that does the calculations for you. So we said Citigroup's at 75 right now. And this allows you to simulate what happens if Citigroup goes higher. So let's say we think Citigroup's going to go to $78. So what happens is it simulates what happens if Citigroup goes to $78 and what is your expected return. So if you had bought 100 shares of that stock, you make about a 3% return. If you had bought this call option at $245, you'd make a 22% return. So this allows you to start comparing what happens if the stock goes in your favor. So if it goes to 78, you make a 22% return. If it goes to 79, you make a 63% return. So this is where the call option really starts to shine. And by giving you the leverage of only costing you $245 instead of $7,500, for every dollar that the stock goes up, you're gonna make a huge return in return for that, okay? So here, if you had bought the stock and the stock goes up to 79, you make a 4% return or 4.3% return. Here on the call, you make a 63% return. This is why options give you leverage, and this is what's attractive to a lot of people when they trade options, is the ability to get this leverage. And if the stock shoots higher and continues going between now and expiration, which is November 17th, as you can see, if the stock hits $80, you're going to make a 104% return on your underlying call option compared to only about a 5% return when you're trading stocks. However, like I was saying, we want to have an exit plan. So when I look at this Citigroup trade, as I can see, there's a support level here around $70. And what we do is we actually calculate for you support and resistance so that you can see where that next support level is. So there's some major support down here around $70. So you might say, what happens? What if I'm completely wrong and the stock goes all the way down to $70? Here, I lose 7.5%, which equates to a $570 loss. Here, even though that I lose 100% of return, but it is only $245. So even if the stock completely collapses down to that next support level, I'm only losing half the amount of money that I would if I had bought the shares. So here I'm losing $570. Here I'm only losing $245 because no matter what, even the stock continues to go lower, I cannot lose more than the $245 I've paid for this call option. Now, and the other thing is, if let's say the stock goes down to $70, but it does it in the next 2 days, right? So right now, today, and one thing that we should point out is that there's earnings on October 12th, okay? So that's 7 days away. So in 7 days, Citigroup will announce earnings. So it's possible that Citigroup misses on earnings, goes down to $70 right after earnings. Our simulator actually allows you to simulate that as well. So what happens if on October 13th, the day after earnings, the stock plummets down to $70? Here it'll tell you, here I'm going to lose, again, $570 on the stock, but here I'm going to lose $213 on the trade. Okay, so as you can see, as the time continues going forward and everything else is constant, I lose more and more money on the call option, and that's the time value working against you. And the time value will continue to work against you when you're long that option. So what happens if the stock goes higher? What happens if on earnings the stock shoots up to $80? Okay, same thing. We can say what happens if the stock on October 13th shoots up to $80 because let's say it beats earnings, it has a really good earnings report, and it shoots up to $80. Here, I'm going to make 118% return immediately. This is why it makes sense to have an exit plan, because if it hits your target price of $80, even if it's just a week later and you still have a full 40 days to go before expiration, it's still time to just take your profits, because you'll want to take profits when it's up 118% If you hold on to it, if let's say you don't take profits and you hang on to it all the way to expiration, look at what happens. The time value starts to eat away at your profits. So as you keep going, you're actually starting losing more and more money, so that even if it goes to $80, you went from, what is this, 118% return if you took profits right after earnings. But if you held it all the way to expiration, it goes down to only 104% return. So that's why it's very, very important, so that if you hit your target price, take profits. Even if there's still plenty of time to go, you're absolutely right. The stock can go higher, even though because if it hits 80 in the next week, maybe it'll go to 90 by expiration. There's always that possibility. But if it doesn't, you're going to lose more money, which is why it's very important to take profits when you can. So let's say you pull up a trade like Citigroup, you decide this is a trade that I want to make, especially with earnings coming up. I think maybe this thing can just, make a pop on earnings. If this is a trade you want to do, you can hit the trade button. Now, this is very important for those of you that are new, because there's a lot of things that you might overlook when you're first starting out with options. It's certainly the case with pretty much all traders that we come across. So what we did is we created what's called a strategy checklist. This is designed to help make sure that you understand the risks that you're taking before you go ahead and place a trade. So let's say I'm brand new to options trading. I'm looking at Citigroup. I think Citigroup's pretty bullish. I want to take a look at trading this option. Well, the first thing we do is we check against 5 things. Number 1, we're checking to see if you're trading with the trend of the stock. Okay, this is designed so that you don't confuse calls and puts or start trading other strategies, and you end up trading a bullish strategy when you want to trade a bearish strategy. So as you can see, it checks against the trend of the stock, it checks against the trend of the market, it checks the OptionsPlay score. The OptionsPlay score is the score here. It's designed to give you an idea as far as what is the risk reward of this trade. In this particular case, it's 87, which is not the best, but it's certainly still okay to take, especially if you have a conviction on the underlying stock. It also checks for earnings. So a lot of times you want to know if there's earnings between now and expiration. So this checks that to make sure that you know if there's earnings between now and expiration. And then lastly, we check for spread and liquidity. So when you're trading stocks, you don't, generally speaking, have to worry very much about liquidity, because liquidity is usually not that big of an issue. But when you're trading options, liquidity is. So sometimes you'll come across a trade where the liquidity is not very good. For those trades, you may not want to take. So that's a word of warning. Even though in the United States there are about 4,000 stocks and ETFs that you can trade options on, not all of them are very liquid. Actually, the vast majority of them are not very liquid. So what we realize is that most people don't really have a good way of telling, is this trade that I'm about to make, is it liquid or not? Because the last thing you want to do is get into an option and not being able to get out. So what we do is we check for all of these things. So based on all the things that I'm looking at here for Citigroup, things look pretty good. I've got 3 green check marks, 2 yellow warning signs, just to let me know, hey, there's earnings. The risk reward on this trade is not the best, but it's still good enough. So once you've looked through the checklist and you decide, hey, this is a trade that I want to make, what you can do is you can click on submit. And what this does is actually pre-fills the ticket for you. This is designed to help save you time, because when you're filling out an order ticket for an option, sometimes it can be a little confusing and tricky, especially if you're new, because you got to get everything right. You got to buy to open, you got to enter the number of contracts, the number of trades, you got to get the right expiration date, the right strike price, the right call or put. So what we do is we eliminate that chance of error, because we fill everything out for you. So you already have everything filled out, and this is the trade that you want to make, you can just go ahead and send that order right off. This is designed to help make trading options as easy as possible, because not only do we help you find the right option trade to make, we'll actually pre-fill that ticket for you. We'll actually make sure that you check for your mistakes and make sure that you understand your risk before you place a trade. So let's just go ahead and take a look at a few other examples. I was looking at consumer staples because it looks like a pretty weak category or pretty weak sectors. So I just want to pull up some bearish examples for you guys, because I think this is why a lot of people like to look at options, because when you're trading stocks, you don't have the ability to short stocks all the time. So a lot of times you might find a stock that you're just, you think is pretty bad, but there's nothing you can do. So options give you that option of being able to short a stock without actually shorting it. So I'm looking at TAP, which is Molson Coors. This is a brewing company based in Canada. So as you can see, the 1 month and 6 month trends here are bearish. So this is telling me that both short and long-term trends are bearish, which is aligned. Great. It's got a technical score of 2, which means that this is a stock that's relatively weak in the overall market. Notice that it recently broke below this 87.5 or so support level, which is currently also a bearish sign. So the fact that it broke support, the trends turned bearish relatively recently here. As you can see, the trends turned bearish on September 13th. Whoa. So these are definitely relatively recently bearish changes that's happened. Combined with the fact that it broke below that support level, these are all signs of kind of bearish trades or bearish views on an underlying stock. So as you can see here below, again, you have the I'm bullish and I'm bearish. So here we will always default to bearish when our trends are bearish. So what we're showing you is 3 bearish strategies, and we're just going to focus on these 2. Shorting the shares, which for those of you that have the ability to short is the trade that you're probably most familiar with, and then buying a put, which is the simple option strategy to take if you're bearish on a specific trade. And what we do is we turn to the same analysis that we did before using this tool. So Molson's trading at 83 right now. This is telling you to take a look at the November 17th, which is the same expiration as the call that we were just looking at on Citigroup, and now it's telling you to take a look at the 85 puts. So a put that's about $2 in the money. So this is saying that if the stock was to go lower, so Molson's at 83. So let's say what happens when we think the stock's going to go to 80. So if the stock goes down to 80, which I think is a fairly conservative view, here if you had shorted the shares, you'd make a 3% return. And this would cost you roughly $8,200 in depending on your margin requirement, but you're likely going to have a large margin requirement in order to short these shares, roughly $8,200 in margin requirement to short these shares. But you can buy a put, which gives you the same bearish outlook on Molson for only $360. This is why this is one of the most popular strategies if you have a bearish view on the underlying stock. So here what we do is, as you can see, if the stock hits $80, I'm going to make a 38% return if I had bought this put. This is why you want to take a look at buying puts instead of shorting the stock. This might be a hard stock to borrow in order to short. You might be paying a large margin interest in order to short the shares. There's a lot of things that makes it much more difficult to short the shares compared to just buying a simple put. So you can use the same strategy to compare these strategies and say what happens if the stock continues going lower. As you can see, the stock, it looks like there's some resistance around this 84, 85 area. So if you think it's going to continue lower to 79, 78, you can easily type in those expectations and see exactly how much money you would make. So here you make a 66% return if the TAP goes down to 79. Or you can say what happens if the stock just goes back up maybe to that next resistance level, 87. So let's say what happens if I'm wrong? So here if I'm wrong and the stock goes back up to 87, here I lose $439 if I had shorted the shares. Here I lose $360 because again, the most amount of money you can lose when you're buying a call or a put is the amount of money you pay for that call or a put. Even if the stock goes to $96, as you can see that you're still only down $360. So this gives you that non-linear payoff graph so that even if you're wrong, the most amount of money you can lose is $360. But if this stock really goes down, let's say it goes down, let's say it really breaks down and it has earnings on November 1st. So what happens if on November 1st, the stock really breaks down, let's say it misses earnings on November 2nd and it goes down to $75? Which is entirely possible. May not be highly probable, but let's just say it's possible. So if that was to happen, the stock drops to $75 a day after earnings. Here you make 178% return on this put strategy, and which is certainly a lot more attractive than making only 9% if you had shorted the stock. And still, even if the stock even if you're completely wrong and this stock really just kills earnings and beats everything on earnings, the most amount of money you're losing is that $360. So this is why trading these types of strategies is extremely popular, especially around earnings, because you can take that view with a very limited risk. So these are two very popular strategies that you can trade. And if let's say you want to trade this put strategy, you can click on trade. As you can see, the strategy checklist here doesn't look as good as the Citigroup example, because I am trading with the trend of the stock, but I'm trading against the trend of the market. So this is also something to consider, right? If we're currently in a very bullish market, which we are, both the 1 month and 6 month trends for the S&P 500 is very bullish. The stock market has been nothing but just bullish for the last quite a few years. You want to make sure that you generally want to trade the trend of the market. So that's one thing that you want to be aware of, is that you're trading a bearish trade in a bullish market. The options play score of 96 is good, so that's okay. It's telling you there's earnings between now and expiration. We're aware of that. And last thing, spread and liquidity is sizable. So this is a little different. This is telling you that this option is trading at $3.30 on the bid by $3.60 on the ask. So this is telling you that if you want to place a limit order, you should place it around $3.50. So when you go ahead and hit submit, this is still stuck on the Citigroup trade, but we'll go back to this real quick. Here we go. So tap, now it's loaded. TAP, November 85 put. So here, this is where you might want to adjust that price of $3.50 as your limit price before you go ahead and send that order. So this is really why we go through these examples, so that we can show you how you can use this tool with some real life examples to quickly understand what your views are on the underlying stock, and how you can quickly find the option trade to make. So I'll just go through a few very quick examples without going through the trades themselves. I'm just going to pull up some symbols that I think most people are familiar with, like Facebook. Here, as you can see, what's interesting about Facebook is that it's got a relatively strong technical score, but the 1 month and 6 month trends have recently turned bearish. And this is a stock that has earnings also on November 1st. So perhaps you might want to look at some bearish trades on Facebook. Or if, let's say, you're looking at what's an interesting sector to look at, healthcare. Healthcare has been a very bullish strategy, bullish sector as well. So Biogen, here's a bullish stock that you can take a look at. Oh, actually, this is a really good example. So here, as you can see, I have relatively bearish views on this sector. The stock itself is relatively strong. The 1 month trend is neutral, so that's not as bullish, at least for me. Let's see if I can find you another stock that's bullish. Celgene, here we go. So as you can see, Celgene, 1 month and 6 month trends are bullish, which is great. This is certainly a bullish stock. It's got a score of 8, telling me that it's a strong stock in the market. But as you can see on this call, I get a really low options play score. What this is telling me is that the risk reward on this trade just simply isn't very good. This is telling me that even if the stock goes in my favor, I may not be making enough money to really compensate me for my risk. So even the stock goes up to 145, as you can see, I'm not going to make any money on this trade. So the stock really has to move quite a bit for me to just make my money back on the underlying trade. So that's really why this has got a low options play score. And this is designed to help you guys, or prevent you guys from making bad trades. Because a lot of times you might say, great, I'm bullish on the stock, let me buy some call options. But maybe sometimes that call option is just not worth it. Maybe the risk reward on that call option is not very good. And that's really what the options play score is designed to do, is very quickly identify which trades are good and which trades are not. Okay? So I can go on all day long, but what I do want to cover again is cover calls. So we've been talking about, if you have a directional view on the underlying stock, if you're bullish or bearish, how can you use options play to quickly find an option trade to make? Now what I want to talk about is what if you own that stock? How can you use options? Okay, so let's go back to maybe Facebook, because I think this is a stock that a lot of people own in their portfolios. How can you use options to generate some income on the stock that you already own in your portfolio? This is actually the most popular strategy for options traders, is cover calls. So as you can see here on the top of your screen, we have a trading tab, and then we have an income tab. So for those of you that are looking to use options to generate some income, and we usually do a separate webinar just on this alone, so we'll probably do that next time. But when you click on the income tab, what we do is we do the same thing. We present ideas to you, but it's going to be based on generating income. Okay, so if you own 100 shares of Facebook, it's going to first of all ask you questions like, do you own shares of Facebook? You can click on yes. You can type in the number of shares that you own. Let's say you own 200 shares of Facebook. You can type in the cost basis if you'd like. And what we do is we tell you what you can do to generate some income. So here, what it's telling you is actually to sell calls. Okay, so this is a little different than what we're doing before. Before, we were buying calls. Now what we're doing is we're selling calls. What does that do? So instead of paying that premium, so remember with Citigroup, we're saying that you pay about $260 to buy that call. What happens is instead of buying that call, you can sell that call, and someone has to sell that to you. So they're going to receive that $260 that you purchased that call for. So this is basically the other side of that trade. And what it does is it generates income for you. So if you sell Facebook, so if you own Facebook and you're selling some calls, here's what it does: is that by selling the October 27th, which expires in about 3 weeks, if you sell the 180 straight calls, it will generate $140 in premium, which produces a 6.7% annualized return. And there's an 84% chance that this call will expire worthless and you keep all the proceeds. Okay, so if you own Facebook, okay, and you own 200 shares of it, it's costing you about $34,000 right now to buy 200 shares of Facebook. What it does is it generates $140 in premium in the next 22 days. And what that does is that annualizes out to about a 6.7% annualized return, okay? So if you own Facebook, this stock currently pays you 0 dividends. So by owning the stock, you have no income, you have no yield. This is a way to generate some yield on your portfolio. So what we do is we actually present these strategies to you. Now, by default, you can actually choose how aggressive or how conservative you like to be when you're selling these cover calls. But by default, we always choose short-dated options, which are from 20 to 49 days out. And we choose the optimal track, which is really not too conservative, not too aggressive. It seeks a nice balance between risk to reward. So by default, those are the settings that we provide to you. I don't have enough time to get into the details of these settings. We have a separate webinar on this specifically. But like I said, it's usually the short-term optimal calls is a good starting point, especially if you're new to options trading. And what this allows you to do is you can type in a stock that you own. So let's say you own Apple. It allows you to very quickly find income-generating opportunities for the stocks in your portfolio. So if you own 100 shares of Apple, you can type in 100 shares, and you'll see that by selling the October 27th 162.5 cover calls, this is a stock that's trading at 155 right now. And by selling this call, what you're doing is you're giving up the right to sell Apple at 162.5. In exchange for that, you're going to receive $56 in income, which annualizes out to about a 6%, which is certainly a nice yield to add to your stock that only pays you a 1.6% dividend. So if you own Apple stock right now, you're only getting a 1.6% yield. By adding cover calls to it, your yield bumps up to 7.6% because you're adding roughly 6% from cover calls. So you can do this as a way to generate income on your portfolio. And we make it as easy as possible for you, as easy as simply typing in a symbol and immediately getting the result as to what stock or which call you can sell. So if you own Coca-Cola, this is saying you can sell the November 17th 47 cover call. That brings in $21 in premium, which is roughly 3.9% annualized return, or a total yield of about 7% because the stock already pays a 3.2% dividend yield. Okay, and this allows you can set up your own watch list. If you have a list of stocks that you already own, you can very quickly go through a list of stocks, that you already own and very quickly see what are the opportunities to generate income on this specific stock. So if you own 3M, this is telling you you can sell the October 27th to 25 calls. That brings in $60 worth of premium, which is about a 4.6% annualized yield on a stock that only pays you a 2% dividend today. So this is just a quick overview of how you can use OptionsPlay for both trading strategies. So if you have bullish or bearish views on an underlying stock, how you can quickly find bullish strategies, or if you click on bearish, it will present you bearish strategies on any underlying stock. And then if you own that stock already, you can generate some income by selling some cover calls. It's a really easy strategy, especially if you're beginners, because it doesn't add any additional risk to your portfolio, and it's definitely a strategy that you should take a look at if you're new to options trading. So with that, that covers what I wanted to go over. And just a quick summary for any of these trades that you want to make. Before you do them, hit the trade button. There's always a strategy checklist that will check a few things for you. If you see a bunch of red things that's telling you, hey, this might not be the best trade for you to make. But if you do want to trade it, all you have to do is hit the submit button. And what we do is we pre-fill the ticket for you so that you can see exactly what the trade to make before you click on send to order. So with that, what I'll do is I'll open everything up for Q&A. If you have any questions, so go ahead and type it into the chat window, and I will answer any questions you guys have regarding the OptionsPlay tool that we just showed you today. So in the group chat window, any questions, go ahead and enter them. Okay, so I got one question. What is the highest OptionsPlay score, and what do you consider an excellent play score? Great question. Because the OptionsPlay score is a risk to reward metric, there is no highest. However, they're color-coded for you, so that you don't have to memorize it. Red means bad, meaning not a good risk reward. Yellow means okay. Red means great. I'm sorry, green means great. So green is the best risk to reward. Green is the best risk to reward. Yellow is okay. Red means avoid. Great question. The next question is this webinar available for view? Absolutely. This webinar is recorded, and you'll be able to receive the recording of the webinar after we're done. Vince is asking a great question. How do we exit a play? So that's something that you can call First Trade on. They'll be able to help you how to exit a trade. Essentially, when you're entering a trade, let's say you want to buy this November 220 put on 3M. When you click on trade, that becomes a buy to open contract. So if let's say you want to close it, it would simply be a sell to close. Again, this is a question that you can call First Trade on, and they'll be able to help you with closing a trade that you have on your existing portfolio. What is the risk for a cover call? Great question. So cover calls is technically what they call a riskless strategy, and it's not that there's no risk. The thing is that you're basically selling a call, but the call that you're selling is hedged with the stock that you own. So even if the stock goes above the strike price, the amount of money that you're losing on the short call, you're actually going to gain on the long stock that you have. So the risk is actually, in my opinion, so if let's say 3M's at 216 right now, and you sell this October 22nd 225 call, what that means is that you have to sell your stock for $225 on October 27th, even if the stock's above 225. So if the stock really takes off between now and October expiration, okay, then you run the risk of having to sell your stock at $225 when it's actually worth more. So if let's say 3M beats earnings on October 24th, let's say it shoots up to $250, your risk is that you now have to sell a $250 stock at $225. So that's really what I consider the risk of selling covered calls, and that's a great question. Deborah is asking, do these options hurt the stock, i.e. if I own it and we are pulling off their profits, my future profits. I think Deborah's referring to cover calls, and that's exactly the example that I just gave with 3M, is that by selling cover calls, you do limit the upside return of the stock. But that's really why we choose these strikes for you, because they have relatively low probabilities of the stock going above them. So the stock's at 216 right now. We've chosen the 225 strikes in 22 days. So that's only 3 weeks out. The stock needs to rally $10 in 3 weeks. There's only an 84% chance that, or I'm sorry, there's an 84% chance that the stock will be below 225 on expiration. So you only have about a 15 or 16% chance that the stock's going to be above 225. And even if it goes above 225, chances are it's probably not going to be much higher than 225. So you may lose a couple of dollars if it goes above 225, but that's it. That's your risk of losing of when you're selling cover calls. And I think that's the question that Deborah is asking. And if it's not, please feel free to clarify. Vince is asking, I have 1,000 shares of Ford. Can you check that out? Absolutely. Ford is a little tougher to find because it's such a low price stock. So as you can see, Ford, I have a slightly different message. So before I had these green check marks when I sell a cover call. When we can't find you a cover call, you get this message that says, hey, we could not find a short-term optimal call for you. We're displaying you the next best alternative. So this is telling you to sell the March 2018 $13 calls. This is not necessarily advisable for you, especially if you're new. Whenever we can't find you a cover call and it's finding you the next best alternative, I don't recommend you to do that, simply because if you're new to this stuff, it's just not a strategy that you generally want to do. So this is going all the way to March, which is 162 days away from expiration, and you're gonna potentially sell your stock at $13 when the stock is really on a pretty nice run since then. So in this particular case for Ford, I actually don't recommend you to sell cover calls, and it's because we could not find you a call that meets your criteria. And what I mean by that, just to clarify, as you can see when I type in Citigroup, here I get this green check mark, right? So everything is green. It's got a check mark. That means we found you a cover call. As you can see here for Ford, it's a different message. Instead of that green check mark, you get the blue with the red warning sign that's telling you, basically saying, hey, this might not be what you want to do. We did find you an alternative if you really want to do it, but this is not the best thing for you. So again, this platform is not only designed to help you quickly identify trades to make, but more importantly, we have built a lot of things into this platform to help prevent you guys from making bad trades. And this is one of them. So when you pull up a symbol, and I think Sprint might be another example of this, it's a low price stock, and you're going to get this warning sign that says, hey, we couldn't find you a stock a cover call that makes sense for you. Especially if you're new and you see this message, move on. Don't try to force a trade when there's not one there. So keep that in mind. Great question on the Ford. Can you explain the chart in the third panel? I think Stephanie's asking about this trade here on the right. So this is a more advanced trade. So here we were talking about, let's go back to the Citigroup example. Here we're talking about buying 100 shares, then we're talking about buying the November 75 calls. This strategy here on the right is a little different. What we're doing is we're buying the 75 calls, so that costs you $245. That's the strategy that we covered here. But at the same time, instead of just buying a call, we're also going to sell an $80 call against it. So what this does is, what we're doing is, it's kind of like a cover call, just instead of owning the underlying stock, you're owning the $75 call. And what that does is, instead of costing you just $245 to buy this call, you're going to bring in 54 cents by selling that $80 call. So and what that does is it lowers the cost of this overall trade from $245 down to only $191. Now, what is the benefit of that? So as you can see on the when we use the P&L simulator, the stock goes in our favor, right? We talked about what happens when the stock goes up to 78. So because this strategy costs significantly less than just buying an outright call, when the stock goes to 78, I'm going to make a substantially higher return on this strategy here on the right because it costs me less money. So as it goes higher, 78, 79, even 80, as you can see, I'm going to make a substantially higher return. And it's all because it cost me less money to enter this trade than buying an outright call. And conversely, if the stock goes against me, again, I'm losing less money because the cost of these trades or what I'm paying for the trades is what I'm risking. So if I'm only paying $191, I'm only risking $191. The only downside to this strategy is if you think the stock's really going to take off. Okay, so if you think the stock's going to go to $85 or higher, so a substantial move, because you traded this vertical, because you've sold that $80 call against it, you're not going to make any additional profits if Citigroup goes above $80. So that's really the downside, right? So if the stock goes to $80, I make $309 or 161% return. But even if the stock goes up to 81, 82, no matter anything above 80, I'm limited in the amount of money that I can make here on the spread. Here on the call, there's unlimited because I can make as much money as possible on the upside the same way I could on a stock. So, and the reason that this strategy here on the right is preferable is because usually within the next 45 days, there's a limit to how far the stock can go. It's a little different when you're buying the stock, right? Because you can hold on to that stock for 2 years. There's a lot of time that you have for the stock to go higher. When you're trading an option, because there's an expiration date, most people feel that the stock's not going to go to 85 or 90 by expiration. So I'm going to trade this vertical. And that's really why this vertical here gives you the best options play score. Because even if it goes in your favor for a little bit, you're going to make more money. If the stock goes against you, you're going to lose less money. So that's an explanation of that strategy here on the right. This is a slightly more advanced strategy, but for those of you, once you learn how to trade a call, once you trade your first call or a put, you definitely want to start taking a look at the strategy here on the right, because there are some great advantages to trading spreads over trading just the calls or put. Jeff, great question, Stephanie. Next question from Jeff is, what fees do you incur in trading options? So it's the commission, just like you do when you're trading stocks, but there is a commission for an extra commission per contract for trading options. So contact your broker at First Trade and they'll let you know what your commission schedule is. I don't believe there are additional fees at First Trade other than your commissions. Next question is, what are the financial requirements for trading options? So that's, again, a question for First Trade. You can contact First Trade. They'll let you know what it requires. You have to fill out an options trading agreement. They have to approve you for options trading before you can go ahead and do that. Just go ahead and contact them and they'll be able to help you with setting up with an options agreement. Great questions, everyone. Is there any more questions on options play or any of the things that we covered here today? You're welcome, Jack. Jane's asking, can you show if you want to buy more contracts? Absolutely. So under each one of these strategies here, and I didn't go into this today, but you can modify any of these as much as you want. When you click on the modify button, you can change the expiration. So if you want to do a longer dated option, you can just click on right to go further out. You can click on left if you want to go further in. If you want to move the strikes up one, down one, you can just do all of that here from the modify. But this is also where you can change the quantity. So if you want to buy 10 contracts instead of one contract, you can go ahead and do that, and everything will change for you, including the P&L simulator. So if you want to buy 10 contracts of this Citigroup call, and you think the stock's going to go up to $79, the profit dollar amount will be reflected based on the number of contracts that you enter. So you can do all of that under, just click on modify for any strategy, and you can change any part of this trade, including the quantity right there. Great question, Jane. Stephanie is asking, how do I sign up for more webinars? So we send out the invites to all the webinars to you. You just sign up whenever we have a new webinar scheduled. We usually do these about once every month or so. So keep an eye out, but they're also always recorded for you after the fact. Stephanie, you might be able to contact First Trade and they can send you recordings of the previous webinars that we've done. Like I said, we do have specific ones that we've done before on trading earnings. We've done ones on trading directional strategies, especially on this third strategy here on the right. And we also have done one specifically on income strategies, so selling cover calls. Jeff, is there an easy way to monitor or automate a transaction so that you can get out when you hit your target price? That's a great question. That's a question, unfortunately, for First Trade in terms of what tools they have in terms of helping you monitor your positions or putting in orders to get out of a trade at a predetermined price. That is a functionality that First Trade may have. You can contact their trade desk and they may be able to help you out with that. Any other questions? You're welcome, everyone. I have one last question is, what is the value of buying long-term expiration? I don't necessarily know if there's a value in it. It just costs more money. So, so for example, we were talking about buying the November 75 calls, which cost $245. Let's go back to one contract for 1 second. It costs you $245 per contract. So if you want to do longer dated ones, so let's look at January 2018, then now it costs you $385 to get an extra 2 months out of it. So, for some people that might be worth it for the extra $140 to get a whole new 2 months. But basically, the longer you go out, the more expensive it is. So here, if I go out to September next year, so almost a full year, it's now going to cost me $720. So more than triple the price of trading a 1 month option or 1.5 month option. But this is a very common strategy. So a lot of times, someone who has a long-term view on Citigroup, they may trade something like maybe a 65 strike call, but a long dated call. And what it gives them is a very similar payoff graph to just owning the stock. But instead of costing them $7,000, it only costs $1,300. So that's actually a very common replacement for just buying the stock, is buying a long dated in the money call is a good alternative to buying the stock sometimes. Linda asked a question. She was a little late, but you're absolutely right. You do not need to own the stock to buy calls or puts, but if you're selling a cover call, you do need to own at least 100 shares of the stock to sell one contract of the cover call. So again, I hope everyone has found this tool useful. Please go ahead and log on, take a look at the tool. It's designed to help, especially if you're a beginner and you're trying to figure out how to implement options for your portfolio. That's exactly why we created this tool, is to allow you, any beginner, even if you know nothing about options, to start exploring, start taking a look at what strategies might be useful for you, whether you're bullish, bearish, or looking for income. It's designed to make it as easy as possible, and we have the tools here to help make sure that you understand your risk. We have that strategy checklist. We built this specifically for beginners because these were the type of mistakes that we saw beginners were making. So we wanted to make sure that you understood your mistakes or understood your risks before you place a trade. And then when you hit submit, everything's pre-filled for you, so you know that you're not making any mistakes when you're filling out that ticket. So thanks everyone for attending this afternoon. I hope everyone found this useful. Again, for those of you that missed this in the very beginning, if you go to the trading tab and you click on options, click on the options wizard tab here on the right, and that will launch OptionsPlay. Thank you, everyone. I hope you guys have a great afternoon. And please, if you have any questions, contact First Trade. They'll be able to help you out. And we'll be back here in the next month or so to do another webinar for you guys. Thank you very much, and I hope everyone has a great afternoon.